We have come across many videos on financial planning, but there is very less content out there which tells you how to do the financial planning for your elderly parents. And today, let's do our bit for our parents. Age plays a very important role in the decision making when it comes to financial planning. A financial product may be great for you, but it may not be great for your aging parents, and vice versa. So, in today's video, we'll talk about 5 financial advice that I would give to my parents, and you should too. And we are doing a giveaway with this video of this Harry Potter box set. And all you have to do is like this video, subscribe to the channel, and tell me in the comments if you have already helped your parents with their financial planning and how did that experience go. Or if not, then tell me which of the advices that we discuss in this video today will you give to your parents. I'm looking for at least 100 comments to announce the winners, so let's get going. What advice would you give to your parents will depend on many factors, like what is the retirement corpus that they already have, what is their financial status, their current lifestyle, their expected lifestyle after retirement, if they have any financial loans, and others. So what product you can use for yourself may not work for your parents. You cannot take as much risk with their money as you can take with your own. Search for products with low risk and moderate returns. See, if you lose some of your own money in the market, you can make it back. You have time. But that's not the case with the parents. So capital preservation is important. And the most important question is, do they have enough fund in the retirement corpus that will sustain them in their retirement? Or do they need to make changes in their lifestyle or need financial support? Suppose their annual income is 6 lakh rupees, the monthly expense is 30,000 rupees, and a one-off annual expense could be 40,000 rupees. In this case, their annual expense is 30,000 into 12 plus 40,000 is equal to 4 lakh rupees. If they are retiring next year and the inflation rate is 6%, then their annual expense will be 6% higher at 4,24,000 rupees. If their investment is earning an average 12% every year and the inflation rate is 6%, then they are earning a net 6% every year. So the corpus required at the time of retirement will be 4,24,000 divided by 6%. That is 71 lakh rupees. Now, once you know the financial condition, you can help them plan their retirement accordingly with these financial advices. Number 1, keep an emergency fund. This is a no-brainer. Your parents should keep 3 to 6 months of their expenses in an emergency fund, which should be kept in a separate savings bank account or a liquid fund. Now, remember, don't access these funds for any planned expenses. This is for unexpected, unplanned situations only. We have a full video on emergency fund. Do check it out. Number 2, make an estate plan and will. Estate planning is the process of assigning and allocating the assets and liabilities to the beneficiaries, basically deciding and recording who will receive the assets. This is usually done to avoid the conflict and minimize the tax burden. Just to clarify, there is no inheritance tax in India per se. But for example, if you are earning any income from these assets, like the rental income, then you will need to pay tax on this income. The assets can be structured in a way to minimize this tax burden. Many finance professionals specialize in the field of estate planning, and they will tell you the ways to protect the value of your parents' assets and minimize the tax burden for those who may inherit it. Health issues and medical costs increases with age, and therefore health could be the biggest expense of your parents after their retirement. And in this case, buying a health cover will be the most important financial decision for their financial well-being. Medical inflation is around 12 to 14% in India, and old age requires proper medical care. So if your parents already have a health insurance policy, then that's great news for you, because very few insurance companies will offer a fresh policy to someone after they cross the age of 50. Medical premium for senior citizens is considerably high, while the cover available may not be as much as you need. It could attract co-payment options and may not cover the pre-existing diseases for a few initial years. So, what can you do to help your parents with these insurance issues? Keep base cover amount low and take a top-up plan. You can take a smaller policy of 2 lakh rupees and supplement it with a 12 lakh rupees top-up plan with a 2 lakh deductible. In this case, your total cost of insurance will be way less when compared to if you would have bought a base cover of 12 lakh rupees. Include your parents in employer's cover. If your employer gives you the option to add your parents under their cover, then do opt for the same. As this is a group policy, it will reduce the cost of insuring your parents. If you can only add your parents or your spouse and children under your employer's cover, then retain the employer's cover for your parents and buy a family floater for yourself and the spouse and the children. This will cost you less. Another important thing to note is that the payment of parents' health insurance may reduce your tax liability, as the payment of premium up to 50,000 rupees for senior citizens is tax deductible. It is important to maintain a steady flow of income even after retirement. For the government employees, it's the pension. For others, they need to have certain investments or assets that can produce a monthly income. And the two most important factors to generate this monthly income is that it should be a steady flow and it should be safe. And there are a few investment options that you can consider for this, like the Senior Citizen Savings Scheme. This is a government initiative that offers quarterly interest payment. The maximum investment amount is up to 15 lakh rupees and the interest rate is around 7.4% per year right now. Pradhan Mantri Vay Vandana Yojana. This is a retirement and pension scheme offered and managed by LIC. The maximum investment could be up to 15 lakh rupees and you can choose the frequency with which you want to receive the pension. It could be on a monthly basis, on a quarterly basis, half yearly or annual basis. Do remember that you can invest in this scheme only up to 31st March 2023. The monthly income schemes of banks and post office offer guaranteed monthly income. Right now, the post office schemes are offering around 6.6% per year. The monthly schemes of mutual funds will not usually guarantee the monthly dividend. Then there are other products like corporate bonds and life insurance annuity products. Corporate bonds are slightly risky and annuity products offer very low return. Insurance and investment should not be clubbed, which makes it a very less recommended option. One important question is, can you invest your parents' amount in equity markets? Well, this depends on what is the size of their retirement corpus. Do they have any other source of income in retirement? And what is their risk appetite? One thing to note is that if the retirement corpus is their only source of income after retirement, then it needs to be safeguarded. The corpus must be kept safe and relatively liquid. Do a periodic check of how the investment is performing. And finally, update the documents. Now, this is an advice for all of us, but especially for our parents, since in their age, a few years back, digitization was not very prominent. So they may have insurance policies and share certificates and other assets in hard copy format, which needs to be digitized. A good practice is to review these documents every 2-3 years, and the family needs to know where the documents are stored and how to gain access if required. So these are the top advices that I would give to my parents, and thank you for watching till the end. Let me know in the comments which of these advices would you give to your parents. Hit the like button if you liked this video, click subscribe and press the bell icon. Wrapping it up, this is Paritosh signing off.